Most people believe investing success comes from picking the right stock, the right fund, or the right strategy at the right time. They believe if they just get that one decision right, everything else will fall into place. But if investing were mostly about intelligence, smart people wouldn't struggle nearly as much as they do. The uncomfortable truth is this: most investors don't fail because they chose the wrong investments. They fail because their habits quietly worked against them. And that belief quietly costs people years, sometimes decades of progress. Because the truth is, the biggest difference between people who build wealth and people who don't have very little to do with what they invest in. It comes down to how they behave over time. And in this video, I want to break down the 3 habits that matter more than what you invest in. Habits shared by the most successful long-term investors in history. Not predictions, not shortcuts, not hype, just the behaviors that quietly decide outcomes. If you've watched my previous videos, you already know this channel isn't about chasing returns, reacting to headlines, or trying to outsmart the market. It's about understanding how wealth is actually built. Slowly, patiently, and often in ways that don't feel impressive while you're doing them. Most investors don't fail because they lack intelligence, education, or access to information. In fact, I'll show you a simple example later in this video where 2 investors make the same contributions, invest in the same market, and still end up with dramatically different results. Not because of what they bought, but because of how they behaved. They fail because their behavior breaks down at the wrong moments. In this video, I'm going to show you why habits overpower strategy, why even smart and well-informed investors underperform, and which 3 behaviors matter more than any individual investment choice. Later in the video, I'll also walk through proof-based examples that show how these habits quietly compound or collapse outcomes over time. Consistency sounds obvious, but it's deeply misunderstood. Most people think consistency means being disciplined, trying harder, or staying motivated. In reality, consistency is about removing decision points. Consistency works because it eliminates the need to be right. You don't need to know when markets will fall, when they'll recover, or which year will be good or bad. You just need to keep showing up. Consistency doesn't require you to be right. It only requires you to stay invested long enough. That's uncomfortable because consistency doesn't give you feedback early on. It feels slow. It feels uneventful. It feels like nothing is happening. That's exactly why most people abandon it. Warren Buffett is often described as a brilliant stock picker. But if you listen closely to what Buffett actually credits for his success, it's not brilliance. It's time and consistency. Buffett has said many times that he doesn't try to predict markets, recessions, or short-term movements. Instead, he stays invested in quality businesses and allows time to do the heavy lifting. A massive portion of Buffett's net worth was built after the age of 50. Not because he suddenly became smarter, but because consistency finally had enough time to compound. Buffett didn't win because he made more decisions than everyone else. He won because he made fewer decisions and stuck to them longer. Here's something most people underestimate. Missing just a handful of strong market periods can dramatically reduce long-term returns. And here's the dangerous part. Many of the market's best days occur shortly after the worst days. So, when investors sell during fear, they often miss the recovery. What makes this especially harmful is that it doesn't feel like a mistake at the time. It feels responsible. Years later, the opportunity cost has already compounded. The market rewards participation, not precision. Consistency doesn't protect you from volatility. It protects you from interrupting compounding. You don't need to be wrong to fail as an investor. You can be almost right and still fall far behind. Waiting for clarity, sitting in cash for just a little longer, hesitating during uncertainty. Those decisions don't feel risky, but they quietly remove the one ingredient compounding needs: time. Almost right is one of the most expensive positions in investing. The cost of hesitation is invisible in the short term but enormous in the long term. Most people assume investing is primarily a math problem. In reality, investing is a psychological endurance test. Markets move not just on fundamentals, but on fear, expectations, and uncertainty. Losses feel roughly twice as painful as gains feel good. A well-documented behavioral bias known as loss aversion. That creates a dangerous loop. Fear feels urgent, action feels relieving, and inaction feels irresponsible. So, people act, not because it's optimal, but because it reduces emotional discomfort. A good strategy executed emotionally becomes a bad strategy. John Bogle understood something most investors never fully accept. You cannot out-discipline your emotions forever. Instead of telling investors to stay calm, Bogle designed systems that assumed people wouldn't stay calm. That's why Vanguard emphasized automatic contributions, broad diversification, low costs, and minimal trading. Bogle didn't try to fix human psychology. He worked around it. His insight was simple but profound. The biggest enemy of the investor is not the market. It's the investor's own behavior. Here's the realization that changes how you see investing. Emotional control is not about being calm, disciplined, or rational. It's about removing yourself from moments where emotion would otherwise decide. Long-term investors don't trust themselves to make good decisions under stress. They assume fear, doubt, and overconfidence will show up. So, they design systems where those emotions are irrelevant. Long-term investors don't trust their emotions. They design systems so emotions don't get a vote. Once you understand this, investing stops being a daily test of willpower and becomes a process problem. And process problems are solvable. If you're being honest with yourself, you probably already know what the right long-term behavior is. The harder part is sticking to it. I'm curious. What do you personally find harder in investing? Staying consistent, staying calm during downturns, or not interfering when nothing feels urgent? The biggest advantage most investors have isn't superior information. It's the ability to stay boring. Simple investors outperform complex ones not because they know more, but because they give themselves fewer opportunities to make mistakes. Complexity creates more decisions, more second-guessing, and more emotional interference. Simplicity creates distance between impulse and action. That distance is where good outcomes are protected. Boring investors outperform exciting ones because they interfere less. The market doesn't reward excitement. It rewards patience and restraint. Minimal interference doesn't mean ignoring your investments. It means recognizing that every decision carries risk, even decisions that feel proactive. Frequent changes introduce timing risk, behavioral risk, and regret-driven reversals. Many investors confuse activity with progress. Doing more often feels productive and quietly destroys returns. Minimal interference is the habit of asking, does this decision meaningfully improve my long-term outcome, or does it just make me feel productive right now? Most decisions fail that test. Peter Lynch managed one of the most successful funds in history, yet he repeatedly warned that investors lose more money trying to anticipate corrections than they lose in the corrections themselves. His point wasn't that markets never fall. It was that investors sabotage themselves trying to avoid discomfort. Charlie Munger echoed this idea throughout his career. Munger believed success came not from brilliance, but from avoiding obvious mistakes. Different backgrounds, different styles, same conclusion. The best investors don't win by being smarter. They win by making fewer mistakes. These habits don't work independently. Consistency without emotional control breaks during stress. Emotional control without consistency leads to inactivity. Minimal interference protects both. These habits don't add up, they multiply. Each habit strengthens the others. That's why long-term success isn't about one habit. It's about how habits stack over time. Here's what this looks like in practice. A real long-term investing system typically includes automatic investing tied to income, not market conditions, clear rules about when changes are allowed, a default response to volatility like do nothing, and long review cycles instead of constant monitoring. This system doesn't depend on motivation, confidence, or prediction. It works because it removes those variables. The goal isn't to feel good about investing. The goal is to make fewer bad decisions. If this way of thinking about investing resonates with you, focusing on behavior, systems, and long-term outcomes, then this channel is probably for you. I don't focus on predictions, trends, or shortcuts. I focus on how real investors think and behave over decades. If that's what you're looking for, you can subscribe. This video is for educational purposes only. I'm not providing personalized financial advice or telling you exactly what to invest in. All investing involves risk, including the potential loss of principal. Always consider your personal financial situation, time horizon, and risk tolerance, and consult a qualified professional if needed. Understanding habits is powerful, but there's one more piece that matters even more: how you behave when markets are uncomfortable. Early on, emotional control matters more than returns. In the next video, I'll break down how long-term investors stay calm when markets drop, headlines turn negative, and emotions push people into bad decisions. If you can master that skill, investing becomes dramatically easier over time. I'll see you in the next one.